One of our favorite topics at Trademark is that we are constantly aware of the market environment and how it changes. And we've got a non-updated version that goes back for many, many years. And the driver of it is the two real questions that are put in a perspective that you can understand with a long-term view of the markets. First, what percent of time does the market make new highs? Just think about that. If you looked at a picture, the picture we're going to show next is from the lower left to the upper right is probably 20, 30, 40, 50 years. And so therefore it shows a progression along the way. But to clearly define, if we put $1 in the market, we want to make money, growth. Growth can only occur from some of the wiggles in the market. I got some neighbors in my cul-de-sac that I like to talk to. They're always kidding me about being a market timer. They're professors. So anyway, I had a discussion about, well, how far down are you? And he said, it really doesn't matter because it's going to come back. Then I got into my real high-end detail. It says, yeah, but you're not making money, you're losing money. And until you get back to all-time highs, only then do you get to the opportunity to make money. And then, the next question that I'd like to discuss is, what percent of the time does the market make new lows or is in a recovery to new highs? So we've broken it down into three things that we'll discuss a little bit in the next slide. As I said, chart's not up to date, but let's do a little housekeeping here and tell you what you're looking at. We have what we call new growth. In other words, if you grow to $1,000, you can't have new growth until you get to $1,001. And as you might could see, the light green is the bullish periods of time, where you get new growth. And for this purpose, it's about 35 to 40% of the time. And that is really the metal that we're tasked with, is for new growth. But you also have to deal with the lower portion of the little pie chart, which is what we call bearish regimes, or the market is making new lows, continually new lows. And that only occurs about 15% of the time or so. But that is how the markets dig us a hole. And we spend an inordinate amount of time in the neighborhood of 50 to 55% of the time in what we call the recovery. While it always goes from growth, from a new high, into some corrective action that can be very small, or in terms of the real bearish regimes, significantly lower by 20, 30, 40, 50%. And then at that low point, we have to dig out of the hole. And sometimes that can be, from a time standpoint, can be extremely difficult and slow. So the time usage of your money is very much in jeopardy in a buy and hold or a passive approach to the marketplace. Just because the recency of the last few years has been extremely productive has nothing to do with what the future might be. And this is our favorite way of showing the growth, the development of new lows, and then the long road to recovery. Sometimes it's a short road. If you don't see the importance of this, it would bother me, because you have no control over the time when you might need your money. Most of us need our money at some point in time. And quite candidly, this is a big, long chart. But it's important to understand that most people really have about 20 to 25 years of their best wealth building time. Not losing it and understanding that the environments change and we have to change our portfolios, it should be foremost in our minds. This is something that Trademark does and always has done for a long time. So the efficient reduction of risk is our catalyst that drives a lot of our returns. Or as my old dad used to say, if you're in a hole, quit digging. It's easier to get out of a little hole than a big one. Thanks.